What if I told you there's a stock sitting under 36 cents right now that some analysts believe could rocket past $3, while at the very same moment, company insiders are quietly selling off millions of shares behind the scenes? Welcome back to Smart Stock Sam, the channel where we cut through the noise and break down what's really happening with the stocks everyone's talking about. Today, we're diving deep into Datavault AI, ticker DVLT, and asking the question that's splitting the investing community right down the middle. Is this the ultimate buy-the-dip opportunity of 2026, or is it nothing more than a falling knife waiting to cut anyone who tries to catch it? Before we get into it, if you're new here, smash that subscribe button because we're about to walk through the technicals, the insider activity, the institutional money flows, and a massive $2 billion deal that could change everything for this company. Stick around till the end because we're also going to map out exactly what could happen in the days ahead. Let's get into it. So here's the thing about Datavault AI right now. Depending on who you're listening to, you'd think these were two completely different companies. On one hand, you've got the corporate narrative, straight from the press releases, painting a picture of a company on fire. They're reporting revenue growth of 443% year over year for the first quarter. They're acquiring companies left and right across multiple industries. And they just announced a jaw-dropping $2 billion structured financing deal. On paper, that sounds like a screaming buy, doesn't it? But then you look at the market reality, and it's almost the complete opposite story. The stock is sitting on a brutal 45.25% loss for the year. Nearly every major technical indicator out there is flashing a strong sell signal, and the company is currently facing serious legal allegations along with heavy insider selling. Could the market simply be wrong about all of this? Or is there something the charts are seeing that the press releases conveniently leave out? Either way, it's rare to see a gap this wide between what a company says about itself and how the market is actually treating it. Let's start with the chart, because honestly, it tells a brutal story all on its own. As of the close on June 12th, shares of Datavault AI were sitting at just 35.7 cents after a rough intraday drop of nearly 9%. This is the kind of chart that looks like it's already given up. If you bought in at the start of the year, you're now staring down a loss of roughly 45% on your position. Now, there was a small after-hours bounce up to around 36.4 cents, a tiny 2% move. But is that the start of something bigger, or just noise before the next leg down? Catching a stock in free fall like this can be incredibly tempting, but it's also incredibly dangerous, unless you understand exactly why it's falling in the first place. Right now, the momentum is firmly pointed in one direction, and the market doesn't seem to be in any mood to forgive. And if we zoom out and look at the moving averages, the picture gets even darker. Moving averages are essentially the footprints a stock leaves behind as it trends. And right now, Datavault's footprints are walking straight off the edge of a cliff. The current price of 35.7 cents is trading below its 5-day moving average of 35.8 cents, its 50-day moving average of 41.3 cents, and its 200-day moving average of 48.5 cents. Every single one of those is flashing red. On top of that, the MACD, which measures the strength and direction of momentum, is sitting in negative territory at negative 0.016. In other words, this isn't some short-term dip happening in isolation. This is a sustained downtrend that shows up whether you're looking at a 5-minute chart or a full monthly view. So with that kind of pressure across every time frame, is there anything in the data that could possibly hint at relief? As it turns out, yes. Here's where things start to get genuinely interesting. When a stock gets beaten down this hard, this fast, it can stretch certain indicators to their absolute limit, a phenomenon traders often call oscillator divergence. Right now, the StochRSI for Datavault is sitting at a remarkably low 17.3. The Williams %R indicator is buried down at negative 92. And even the 14-day RSI is hovering around 31, right on the edge of oversold territory. In plain English, the selling has been so relentless that the market may genuinely be running low on sellers, at least for the short term. Add to that an average true range of over 1 penny a day on a stock trading around 35 cents, and you've got a recipe for serious intraday volatility. Could this combination of stretched indicators be setting up a sudden, sharp relief rally? It's possible, but before you get too excited about that bounce, there's something else you need to see first, and it might change how you feel about jumping in. And this might be the single most important piece of data in this entire breakdown. Over the past 6 months, there have been exactly 0 open market insider purchases of Datavault AI stock. 0. Meanwhile, there have been 20 separate open market sales. Think about that for a second. The people who know this company best, from the inside, haven't bought a single share on the open market in half a year, but they've sold 20 times. Silex Holding Company completely exited their position, offloading more than 30 million shares and pulling out around $31 million. Vivasor Incorporated dumped 20 million shares of their own. And it's not just the big holding companies. The chief accounting officer and one of the company's directors have also been selling shares, right near 52-week lows. To be fair, insiders still control roughly 36% of the company, so they're not walking away entirely. But when the people closest to the business are selling near the bottom instead of buying the dip, doesn't that tell you something about how they feel about the near future? And a lot of this hesitation seems to trace back to short seller reports accusing the company of running little more than a stock promotion scheme, which has triggered ongoing legal scrutiny into how the business actually operates. Now, if insider selling alone wasn't confusing enough, wait until you see what's happening with the big institutional players. Because right now, Wall Street's so-called smart money is completely split down the middle. On one side, you've got major accumulators. The Vanguard Group increased their position by an almost unbelievable 912%, picking up close to 11 million shares. Goldman Sachs went even further, boosting their holdings by more than 3,000%. These are not small moves. These look like bets on a major turnaround. But flip to the other side of the board, and State Street Corporation slashed their position by 85%, while Jane Street Group walked away entirely, liquidating their full 4.5 million share stake. So here's the question worth sitting with. When some of the largest financial institutions in the world are taking completely opposite positions on the same stock at the same time, who do you think ends up being right? To understand why firms like Vanguard might be willing to bet big here, we need to look at the numbers management is throwing around, because they are bold. Let's break down the bull case in 3 simple numbers, because if even one of these holds up, this stock could be massively undervalued. First, that 443% year-over-year revenue growth we mentioned earlier, in a market where most companies are fighting just to post single-digit growth. A number like that practically screams for attention. Second, management has set a base revenue target of $200 million for 2026. And third, they claim to be sitting on $800 million worth of tokenization-related contracts. Just stop and think about that for a second. If even a fraction of that $800 million backlog gets converted into real revenue, the current market value of this company starts to look almost laughably small. These are the exact numbers the bulls are pointing to every single time someone brings up the falling stock price. But numbers on a slide are one thing, actually executing on them is another. And Datavault isn't just hoping organic growth carries them there. They're actively trying to buy their way to those targets. This company is executing what can only be described as an aggressive, multi-sector expansion strategy. In cybersecurity, they've signed a binding letter of intent to acquire CyberCatch Holdings for 140 million Canadian dollars. In healthcare logistics, they formed a new entity called DVLT AI, scooping up biometric data companies, drone logistics intellectual property, and a majority stake in Talo Health. And as if that weren't enough, they're also pursuing a dividend spin-out of their acoustic sciences division, which would create an entirely separate, standalone public company. It genuinely feels like they're trying to build an empire almost overnight. But here's the obvious problem. Building an empire takes serious capital, and for a company that's burning through cash, where exactly is that money supposed to come from? That brings us to what might be the single biggest piece of this entire puzzle. On June 1st, Datavault signed a term sheet for a massive $2 billion structured financing transaction. This is essentially the fuel they're counting on to power their entire expansion plan. The deal is broken into 4 separate $500 million tranches with a proposed issuance price somewhere between $1.55 and $2 per share. Let that sink in for a moment. The stock is currently trading around 35 cents, and this deal is structured at a price more than 4 times higher than where it sits today. If this gets executed as planned, that kind of premium would be incredibly accretive for existing shareholders. But, and this is a big but, capital at this scale never comes free. In exchange for this lifeline, Datavault would have to hand over majority board control to the investor group behind the deal. On top of that, there's a steep, non-refundable $25 million fee attached to every single tranche. So really, the question becomes, are they trading away the keys to the company just to keep the lights on? And if so, is that a price worth paying for long-term shareholders? So with all of that on the table, the brutal chart, the insider selling, the legal questions, what are professional analysts actually saying about where this stock is headed? Surprisingly, the consensus leans heavily optimistic. The overall rating tracked on Market Screener currently sits at outperform, and Maxim Group has issued a firm buy rating on the stock. Their average price target sits at $3 per share, from the current price of 35.7 cents. That works out to an implied upside of more than 740%. 740%. Analysts appear to be pricing in a scenario where that $2 billion financing deal actually gets executed at that $1.55 to $2 premium range. In other words, Wall Street seems to believe the long-term growth story outweighs the short-term pain of dilution. But is that confidence justified? Or is it built on assumptions that may never come true? Here's the reality. Because of just how polarized this situation is, your entire approach to this stock depends almost entirely on your time horizon. If you're thinking short-term, we're talking days to a couple of weeks, then the fundamentals barely matter right now. What matters is a potential technical relief rally, driven by those deeply oversold conditions we walked through earlier. But the major risk here is that any bounce could immediately run into a wall of continued insider selling, capping the upside before it really gets going. On the other hand, if you're thinking long-term, months or even years out, then the only thing that truly matters is whether that $2 billion term sheet actually gets finalized and executed. The risk on that side is just as real. Giving up board control could seriously dilute existing shareholders' influence, and ongoing legal investigations could end up proving that those headline-grabbing growth numbers were never as solid as they appeared. So which side of this are you more interested in? Let's zoom in on the week directly ahead and see what a short-term setup might actually look like. For the trading week running from June 15th through the 19th, the immediate setup points toward what's often called a mean reversion scalp trade. The overall bias here is a cautious short-term technical bounce, and I want to stress, cautious, because the broader trend remains a steep downtrend. This kind of setup is really only appropriate for traders with a high tolerance for risk. This is not the kind of stock you marry. As far as execution goes, the idea would be to let the early week volatility settle down on Monday morning rather than jumping in right at the open. From there, the focus would be on entries near the classic daily pivot point around 35.7 cents, or ideally catching a flush down toward classic support 1 around 35.4 cents. But what happens if that support doesn't hold? Let's map out exactly where the lines are drawn. So here's what a tactical price map for the week might look like. The target entry zone sits roughly between 35.4 cents and 35.7 cents. Once in, the idea would be tight, well-defined stop-loss zones, Primary support around 35.4 cents, secondary support around 35.2 cents, but the real line in the sand, the critical level, sits at 35 cents flat. And here's the warning: if price breaks below 35 cents on real volume, that effectively invalidates the entire bounce setup. It would signal further capitulation, and at that point, cutting losses quickly becomes the priority rather than holding on and hoping. On the upside, the take-profit zones are just as clearly defined. The first target sits at 35.9 cents, the second at 36.2 cents, and the final target comes in at 36.3 cents. The idea would be simple: take profits into resistance and don't get greedy chasing more. But zooming all the way back out, what's the actual bottom line here? At the end of the day, Datavault AI represents one of the most polarized risk-reward setups you'll find anywhere in the market right now. The promise side is enormous: explosive reported growth, a $200 million revenue target, an aggressive acquisition spree across multiple industries, and a $2 billion financing deal that, if it goes through, would justify that $3 Wall Street price target. But the peril side is just as extreme. Toxic technicals across every time frame, intense and ongoing insider selling, and serious reputational damage stemming from legal probes that question the very legitimacy of those headline numbers. So what's the actual play here? For long-term investors, this remains an extremely speculative bet until that $2 billion financing deal is officially signed, sealed, and confirmed. But for the week ahead, this looks like it's purely a technical trading vehicle. Stay disciplined around that 35-cent support level, take profits if price reaches the 36.3-cent zone, and let the rest of the market argue about the fundamentals. Now, before we wrap up, a quick but important reminder: everything covered in this video is for informational and educational purposes only and should not be taken as financial advice. I'm not a licensed financial advisor, and stocks like Datavault AI, especially ones trading under $1, carry an extremely high level of risk. Always do your own research and consider speaking with a qualified professional before making any investment decisions. With that said, what do you think? Is Datavault AI a falling knife you'd never touch, or do you think that $2 billion deal is the spark that turns this whole story around? Drop your honest takedown in the comments. I genuinely read through all of them, and I'd love to hear which side of this trade you're leaning toward. If this breakdown helped you see this stock a little more clearly, do me a huge favor and hit that like button. And if you're not subscribed yet, now's the perfect time, because we cover setups just like this every single day. And if you really want to support the channel directly, you can send a super thanks using YouTube's built-in support feature. Every bit genuinely helps keep this content going. Finally, if you're serious about leveling up your investing and trading game, I've launched a channel membership where you'll get access to an exclusive community built for traders and investors who want to go deeper. More breakdowns, more setups, and a space to learn alongside people who take this just as seriously as you do. Come join us. Until next time, this has been Smart Stock Sam. Trade smart, manage your risk, and I'll see you in the next one.